Hello everyone and welcome to the next accounting tutorial. So last time I threw a lot of information at you and I pretty much ended with, hey, with accounting we have all these assumptions and principles, and we have, also accrual accounting. We care about action, not cash, and then we use these pretty much self-explanatory accounts for the most part to record all of these business actions into an accounting equation. And I said pretty much one of the best ways to go about this, and different people do it different ways, but I think the best way to go about learning this is to simply say, hey, let's just talk about a business transaction. Let's talk about how it's recorded in this accounting equation, and let's tie it back into why. Why did we do this? Why does it make sense with this sort of layout of assumptions and principles we have? So I'm just going to do, and also, as you can see here I've updated this accounting equation to add a date. A date is a really important aspect that I sort of skipped over last session in the accounting equation. You always want to keep track of when stuff happens. So that's what I've sort of added. So without further ado, let's just get cracking. So let's say that on January 1st, someone started a business. An investor started a business, and they invested $100 into the company that they're starting. So this accounting equation, for the most part, this is going to be, unless specifically stated otherwise, always assume the accounting equation is from the company's perspective. So the investor put in $100 worth into this business. The accounting equation is from the business's perspective. So the business got $100 in cash, and contributed capital is $100. Now, what is contributed capital? Contributed capital is just an accounting account that accountants made to keep track of how much the owners have invested in the company. How much the owners have invested, personally invested. So it makes sense. It's under owner's equity. And again, contributed capital to the capital cash the investors had contributed. Pretty self-explanatory. Now, and again, I just like to point out this makes sense on a couple different methods. So one, separate entity principle. When we recorded this, we said the investors gave $100 in cash, $100 in contributed capital. We didn't put the owners or investors' cars as assets on the books, or their house, or their stocks, or their bonds. If the investors owed someone money, we didn't put it in liabilities. We only put in the $100 in cash because the company received directly $100 and it's theirs. So separate entity, we didn't put anything else of the owners on this accounting equation. And then also monetary unit, obviously this was easy, $100 in cash. So over here we're going to say this contributed capital was $100. They invested $100. Everything's put into a monetary unit. So also on January 1st, let's say, and you know what, let's give ourselves some wiggle room to work with. Let's say actually investors put in $1,000. And just keep things simple. As you can see here also, the accounting equation balances. 1,000 on one side, 1,000 on other. So let's say that, and I'm just keeping numbers here simple and everything. So let's say also this business needed a place to operate. So the business decided to rent out an office. And the landlord said, hey, you're a new business, so I want you to pay all money all up front. And we said, okay. So he said it's going to be $120 for the year. So actually negative $120 in cash, because we're paying $120 in cash for the whole year of rent. Now, again, this is where we're not cash basis, we're accrual. We care about the actions. So we don't care about this cash here. So we're not going to go over here in owner's equity and say, oh, rent expense, $120. No. Because we haven't actually used this rent. We have a whole year's worth. We have the rights to use this building for a whole year. So how do we record that? We're going to say we have $120 worth in prepaid rent. Why does this make sense? Well, it ties back right here. We're not cash-based, we're accrual. The action has not occurred. We have not actually used this building, so we're not going to expense it yet. In monetary unit, this is $120 because the historical cost is we paid $120 for it. Now, let's say that, maybe the CPA exam or who knows what, let's say they're trying to trick you, and they added some information, and they said, yes, you paid $120 for this rent, but the owner, the renter, he was a dummy. It's actually worth $240 for the whole year. The fair market value was $240, but you just got it at a steal for $120. Well, we don't care that it's worth, historically, we don't care that it's worth on a marketplace $240. We don't care about that. We care about historical cost. So it ties back in. We paid $120 for it. We're going to record it at $120, regardless of whatever fair market value is. Let's say the owners, they put in $1,000 in cash, but they also said, well, we put in $1,000 in cash, but, we're going to put in a lot of time and effort, and we're going to, we're experts in our field. The fair market value for what we're investing in this business is actually way more than $1,000. It's true, but we don't care about the fair market value. We care about the historical cost. $1,000, $120, $120. That's what we paid for it. It's not what some fair market value is. So anyway, the investors started the business, put $1,000 in cash into it. Then they paid some cash. The business, I should say, paid cash, and they got some, prepaid rent so they can use it for a whole month. So then let's say, I'm just going to make some good example here. Let's say that also to do all this, we had a lawyer. Gotta love the lawyers. January 1st, and we paid $300 in cash to a lawyer for services that he did. He or she did. The lawyer, they sent in the paperwork, they did all the advising, blah, blah, blah. They don't owe us any service in the future, so they performed this action of legal work, and we're paying them for it. They did it, and we paid it for it. This is the very beginning of the year, very beginning of the company. So we paid them $300 in cash, and then minus $300, and then legal expense. Again, I hope you see here, accountants, we don't try and get all crazy with the names. It's legal fees, so we call it legal and expense. It is an expense. As you can see here, also, the accounting equation is balances. Negative one side here, negative the other here. Now here we call this like an asset swap. You're just swapping one type of asset for the other. Oh, and you know what? This doesn't need to be in parentheses. One type of asset for the other. So decreasing cash, but we're increasing this intangible asset. We can't touch it. We call it an intangible asset of prepaid rent. And then over here, we're paying cash, but we actually, used it, the legal stuff, it happened in the past, it happened right away, so we're actually going to expense it because we use this legal stuff, it's done. So that's the difference, I hope you can see here, between this type of thing that we're prepaying, we haven't used it, so we're not expensing it. The economic substance isn't there, but the economic substance for the legal fees to start the company, that is there. We've done it. So anyway, let's say next what we do is we bought some equipment. Who knows what we're using this for, But on January 2nd, we bought equipment for $200. Let's keep it $240. So cash went down by $240, and then we got $240 in equipment. And again, that's an asset swap. And equipment, equipment means that it's some large thing, normally expensive, that we're going to use for more than a year. So equipment is longer than a year. It's some big thing. Also, sometimes accountants like to say operating cycle. Well, I'll get into that in later tutorials. But for right now, we're just going to say equipment. It's something we're going to use for at least longer than a year. Normally, it's at least a couple years, and it's normally a big ticket item. And equipment is just used to help run the business. And again, this equipment hasn't been used up. We just got it. So it's an asset. It's something we have. And then let's say on January 3rd, we bought some, we paid $100 in cash. You paid $100 in cash. So we get $100 in supplies. Now, what's the difference between supplies and equipment? Equipment is long-term, at least more than a year, sorry, and we're going to use it for a while. Supplies, short-term, normally less than a year. Normally, some supplies can be who knows, maybe a month or a week or so. A good way to visualize this is if you've ever seen an assembly line, those huge machines that just are making stuff and cranking stuff out, that's equipment. Supplies is something smaller. Trash cans, pens, pencils, paper clips, staples, things like that. Things that you just use. Small, you use them right away. Those are supplies. And then let's say on January 4th, we pay, let's just say we pay $200. So 200 because historical cost, what we paid for it, monetary unit has to balance. $200 for inventory. Now, what's the difference? What's inventory? Inventory is something that we're going to sell. Alright? So we're going to sell this inventory. Supplies and equipment, we're not selling that. That's not our normal course of business to sell it. But inventory, it's our normal course of business to sell this item. That's what we do. It's our business model. We sell this item. We don't sell supplies, we don't sell equipment. So I hope right away you're figuring out that equipment, supplies, and inventory are going to be different for company to company. So for the most part, pens are going to be supplies, just something an office uses in the normal course of business. But if you're in the business of selling pens, pens will be in inventory. Same thing with equipment. Let's say you bought a truck to help you move things around a factory warehouse. That truck is going to be equipment for you. Unless, of course, you're in the business of creating trucks and selling them, then that truck is going to be inventory for you if you plan on selling it. So, again, these things, specific items will change company to company depending on what they plan on doing with said item. So if it's a long-term thing, they're just going to use in the course of business, just to help them continue on with their business, is equipment. Short-term, very usable, it's supplies. If they plan on selling it, that's inventory. And those things can change from company to company. And again, notice, these are all kinds of asset swaps. We haven't used this stuff yet. We haven't sold this stuff yet. There's no expenses, even though we're paying all this cash. Even though we're paying cash, all these, we're not going to call these expenses. We haven't used them. They're not matched to any revenue. So, 1,000. I just want to make sure really quickly. You'll have to excuse me. I'm trying to do some mental math to make sure we have enough cash in our coffers here. If not, this is just 3. Yeah, so we should be good. But again, sorry, if I end up going over, just know in real life you can't ever spend more cash than what you actually have. Well, I mean, sometimes in real life you set up what's called a line of credit with a bank, so you can get cash really quickly and stuff like that, but, that involves interest, and that's a type of loan almost. For the purposes of this specific tutorial right now, this video, I'm not going to get into that stuff, so just know that if I end up going over some account, I'm going to try not to, but just bear with me, I'm sort of making this example from scratch. But you should always have enough cash. You know, cash is king. It's what makes the business float. So anyway, so we have inventory, we have supplies, we have equipment, we have some, you know, we have a building with rent. And let's say that at the very end, we get a customer. Woo! So January 10th, a customer comes in and they buy, you know, let's say here, inventory. Oh, I forgot to give you, you know, normally you always want to keep track of inventory. So we paid $200, 200 inventory. Let's just say that we have 20 units. So 20 units of inventory. You know, this is really important to keep track of. Whenever you're buying inventory, something like that, you're always going to keep track of how many units you have. So let's say January 10th, we have our first sale. Yay. We sell 5 units of inventory. Okay? We sell 5 units of inventory, and we sell those 5 units for $1,000. So we get $1,000 in cash, and then over here we finally have $1,000 in revenue. Yay! So we got cash for selling, and this is revenue. You know, and that's pretty self-explanatory. You know, again, it makes sense. It's an owner's equity. It's, you know, what's involved with the ownership of the company. Well, everything's involved with the ownership of the company. But again, it's not a liability. It's not something we owe anyone. So, you know, it's owner's equity. Contributed capital, legal expense, but, you know, revenues and expenses and contributed capital, they go in this owner's equity. And so, you know, revenue, we got $1,000 in revenue. Now, but here's the thing. Every time you sell something, sell something tangible, there's 2 aspects of it. There's there's the revenue side of things, and then there's the expense side of things. So we sold, you know, what did I say, 5 units? So over here we have $200 worth of inventory, $20 units. So that is going to be $10 a unit. So we sold 5 units of inventory. So that means 50. You know, so sold $5 of 5 units of inventory worth $10 each. You know, just did that there. 50 inventory goes down by $50, and over here, cost of goods sold. So we recognize revenue. Now we need to recognize the expenses that go with it. You know, sure, we got this money, but we also decreased our inventory. Now we're actually recognizing expense. Not when we paid cash to get this inventory, but we actually recognize this expense right here. So because we're recognizing the revenue. So now we're going to recognize the expense, $50 inventory. And again, you know, this is always going to be a cash amount. And again, going back up here, you know, the matching principle. We're matching the revenue towards expenses. Historical cost principle. You know, it doesn't matter, you know, what this inventory, you know, if we were to go and, you know, pay more money for inventory right now, how much, you know, that would be. Well, sometimes it does. I'm getting into a complicated method right now, but, you know, we're going to make some simple examples, and again, you know, it's the historical cost. You know, we're going to say historical cost here. Now, so we got some cash, we recognize revenue, we're doing really well. So let's say that on January 15th, we go to a marketing company and we say, hey, we want a better word of mouth on this. So we're going to pay you $100. Oh, $100 right now in cash. Going to pay you $100, and we want you to market our product. And then the marketing company says, great, that's wonderful. So here's what we're going to do. Pretty much right away, the next day or two, we're going to give you $50 worth of marketing. You know, we're going to go out and we're going to print off these flyers right now, right away. You know, and again, emphasis on the, you know, the timing here. Always be aware of your time. You know, right now we're going to give you $50 worth of marketing. So we say, okay, that's great. And we're paying you $100, so $50 in marketing expense. Because it's happening pretty much right now. But the other $50 we're going to have to wait until next month to do. So then we say, okay, so negative 100 here, 100 here. So we're going to, as is customary, prepaid marketing. So now we have prepaid marketing. $50 of it we used happen right now, but the other 50 is going to be next month. So again, I hope you see, a trend here. You can see how we use the logic of these assumptions and principles to make this, general type of accounting entry, and how this, pops up again and again and again. A lot of people, they try and think, oh, I need to memorize an accounting. I need to memorize all these accounts. Well, no, just memorize the logic. You pay cash for something, but you don't use it right away, so you're going to make it an asset. Bam. If it's inventory, then it's inventory. That's the asset. If it's some prepaid, it's some prepaid. If you use it right away, well, you're going to expense it right away. And then, there's no rule saying that, it can't be split up to meet economic substance. So let's say, again, the marketing company, they tell you, well, you're going to do half right away and the other half will be next month. Make sure, you know that and record it based on the economic reality of the situation. And again, just tie everything back to logic and why it makes sense. And just, look at these. Try, obviously at the beginning, if you have to memorize them, sure, just to get an idea of the accounts. But really, ultimately, you should be logicking through why this makes sense. And again, you notice these patterns right here. These asset swaps, they pretty much all have the same, logical point to them. Sure, we're paying cash right now, but we have an asset. Why is it an asset? Well, because we have it and we haven't used it yet. So anyway, I don't want to harp on anything too much. So, moving on, let's say that, finally, we used 5 units of inventory, so we have 15 left. Let's say the marketing really paid off, and we sold our other 15 units of inventory. So, on January 30th, we sold 15 units of inventory. And let's say, heck, we raised the price. We didn't care. So let's say that 15, we got $1,000 for 5, which if we kept the same price would have been $3,000 for the other 15. But, let's say we added some premium, who knows? Increase that price. So we get $4,000 in cash, so we're going to recognize $4,000 in revenue. And we're selling 15 units. It was at $10 a unit. So 150, negative 150, and that is going to be, and I'll just abbreviate, cost of goods sold, COGS. Again, every every sale of inventory is going to have at least 2 aspects to it. The cash and the revenue, and the cost of goods sold. Now, the end of the month has happened. And that means we're going to do something called adjusting entries. Now, what are adjusting entries? Adjusting entries are saying, hey, throughout the course of accounting, we're going to make, we're going to make accounting entries based on assumptions. Not just assumptions, but economic fact. But this economic fact will change over time. And, what do I mean by that? Let me put it into example using it right here. We said we're going to pay $120 for prepaid rent, and we haven't used any rent yet. So it's going to be an asset of prepaid rent. $120 for rent. And then, of course, the economic reality at this point in time was we didn't use any of it. Well, now we're at the end of the month, and we're going to adjust. Well, we have used of it. We've used 1 month of that prepaid rent. So pretty much, adjusting entries are just going through and looking at all of your entries and saying, okay, has the situation changed? And normally the situation changes with any type of prepaid or equipment or supplies or inventory, anything that, actually you can see changing a lot. So, a lot of these accounts have some type of, change in them and adjusting entry. So I suggest just going through your month and seeing, okay, and all the information saying, hey, okay, does anything change? So we're just going to call this adjusting entry 1. So adjusting entry 1, pay, get $1,000, $1,000 contributed capital. Nothing's changed there. We didn't expect anything to change. That happened. Next, prepaid rent. Okay, well that has changed because we've paid for a whole year and 1 month has gone by. So we're going to expense away 1 month. So, I hope you realize, I set this up, so 12 months in a year, so $10 a month. So -10 and prepaid rent. So because prepaid rent is going down because we actually used $10 worth of it, -10 rent expense. Bam. That's the first adjusting entry. We've used a month of the rent, so we're going to take away this prepaid rent because we don't have as much prepaid. We don't have as much rights to use. And now we're going to say, okay, so rent expense. We're going to recognize the expense. Why are we doing this? Because the economic substance, accrual, the action, that was, the actual initial entry was a deferral where we had dollars first and, the action happened later. So that was actually a deferral, but we're accrual accounting, and now the actual economic substance has changed. So we actually because we used a month of that prepaid rent. So, moving onwards. The next thing, the legal expense, okay, we took care of that right then and there. That happened. We don't need to worry about it. Next, equipment. Now, here's the deal. Equipment is very can be a very complicated thing in accounting. There's a lot of issues that happen with equipment, a lot of ways to account for equipment. But this is just, your initial exposure to it, so I'm just going to plant the seeds and give you a really simple idea. Okay? So we have $240 worth of equipment. And again, we expense things as we use it. So ideally, not ideally, but the reality of it is this equipment is not going to last forever. It'll eventually go away. Eventually become either obsolete or no one will use it. So the basic function, the basic idea of equipment is figuring out how long this equipment is useful, and then using some type of method to allocate this cost, this historical cost, to those periods of time throughout its useful life. So there's a ton of different ways to actually do this in accounting, and it can get really complicated, but for right now, we're just going to say, let's just say it has 2 years or 24 months worth of useful life, and let's just say we're going to take this historical cost and we're going to split it evenly amongst those 24 months. So essentially 1 month is 10. $10 used of equipment. So as you can see right now, going to -10, and we're going to call this depreciation expense. Why? Because, this is an asset, we're not paying anything, but it's depreciated. Depreciation just sort of means used up. Of this usefulness of this asset, we've used up $10 worth of it. And again, this is not the only way to do this, to calculate depreciation, is by splitting it up over, equally. There's a lot of different methods to calculate depreciation expense, ways to account for it, but we're just going to, just do what's called straight line, essentially. And again, there's more complicated things, but we're just going to keep it simple right now. So -10, it's a depreciation expense. Again, expenses are negative. Why? Because, expenses are taking out of equity. The owner can't claim, expenses. They can't claim a business if, some expense happens. So expenses are negative. So it's depreciation expense, the asset's depreciated. Now over here, you might be thinking, okay, and we use part of the equipment, so we're going to do -10 equipment. No. So here's the deal. It's -10, all right, but we're actually going to call this account accumulated depreciation. And when we, and I'm going to go into examples of, the balance sheet and how financial statements look and how they're presented. But essentially, accumulated depreciation is what we call a contra account, which means whenever we talk about, like this contra account, it's always in relation to some other type of account. And contra means, against, taking away from. So if someone were to ask an accountant, hey, what's our equipment looking like? Instead of saying, oh, our equipment is now $230, here's what the accountant would say. The accountant would say the equipment is $240, accumulated depreciation is $10, so net is $230. That is the language that accountants will use. And why do they use this? Why go through the trouble? Why not just take it right out of the equipment? Well, the idea is that equipment is such a big, costly, useful, purposeful thing that we want to have more information on it. We don't want to, just say, oh, it depreciated over time. We want to keep track of how much we paid for it, how much we say we've used of it, and then how much is left over. So again, this is sort of to give people more, more information. That's why we have this contra account, accumulated depreciation. Takes away from equipment, but we're not going to subtract straight from equipment. Like we sort of subtracted straight from inventory or something like that. Just because the nature of its equipment is really important, we keep track of it in a certain way, and again, as you can think, as we move on, and maybe even managerial accounting, we'll talk about, hey, again, a lot of ratios and all these things are based off of how much money you can squeeze out of average equipment or who knows what. So, again, just for more information, we're going to make this, again, contra account, accumulated depreciation. So anyway, sorry, that was my spiel on that. So next, let's say we have supplies. That's really simple. You had $100 worth of supplies. We're just going to look. And we're going to say that we just, looked into our office and we saw that we only had $50 worth of supplies left. So if we had 100, we only have 50, well, that means we must have used 50. So we take away 50 from supplies, and -50 supplies expense. I hope, hopefully you're seeing a pattern here. Okay, well, this went down, and so we're going to finally expense it. Because the economic reality, the economic substances, now it's gone. So, then we do that. So that's, that's a simple, cash and inventory, that happened, we recorded that, more cash and, cash and supplies, cash and inventory, then we had a sale, that's all completed. Then we had marketing. Now, I said, again, I don't know if you remember, but with my example, I said, okay, the marketing company said, we'll do $50 now, $50 next month. So they didn't do anything additional this month, so we don't need to adjust for that because nothing happened this month. And then this is just a sale. So, this is sort of like the basic framework. So you can see here, we have all these accounts. They're affecting different things. And, again, I hope I've sort of explained to you a lot of basic, just accounting ideas. Basic, this has happened, and here's how we account for it, and here's why. And again, I hope you can just review and understand how all of these types of, assumptions and principles go into things. And just to quickly go over, separate entity, we talked about that. Monetary unit, we've been recording everything in dollars. Time period, we've been keeping track of time because eventually we're going to make statements Financial statements, we're going to get into that next session. And, that'll be split up into time periods. Going concern, we're not worrying about this company going out of business. We're not acting like it will. Let's say that, and again, that's sort of shown in like this equipment accumulated depreciation account. We're going to split up the cost of this long-term item over 2 years. We don't technically for certain know that this company is going to exist in the next year, but we're going to assume it will. We're going to assume that a company will continue. Everything's been at historical cost. We've recognized revenue when it's earned. We've only recognized things, matching principle, and full disclosure. We're trying to keep track of everything that's useful. Now let's say the next month happens. So February 1st. On February 1st, we're going to have a little bit of a different situation. Let's say we want to get more inventory, because I believe, we've used up all our inventory. We want to get more inventory, but for whatever reason, let's say we're a little bit worried about cash. We want to keep more cash on us. So let's say we go to our supplier and we say, hey, listen, we want to get more inventory, but we want to pay cash at the end of the month. And the supplier says, okay, that's fine. Now, I'm just going to give you, a little, background here, or not background, but just to let you know, this is actually a more complicated situation than what I'm going to make it out to be. In reality, when you pay for something later, there's normally some type of deal or interest involved, and that'll be stuff we get to in the future. But for right now, let's just say the supplier said, that's fine. I'm not going to charge you interest. I'm not going to, have any deal or who knows what. You can just pay me at the end of the month. So let's say we buy, the units. I'm just trying to keep track of things. Let's say the prices have changed. And instead, we're going to get $200, $300 in inventory. Let's say it's 15 units. Prices have changed. 15 units. So you can do right over here. Woohoo! Sorry about that. My computer's freaking out. 300 divided by 15. $20 a unit. So $20 a unit, oh, that might have been what we had anyway. Okay, it doesn't matter, sorry. So $300 in inventory, but here's the difference. The difference is going to be, we do not have the we don't want to pay you right now, we're going to pay you at the end of the month. So over here in liabilities, 300, we're going to call this, we owe the money payable. So all we did is, instead of decreasing cash, increasing assets, increased assets, and increased this liability. We owe them $300. It's an account that we have to pay. Accounts payable. Really, really ingenious, I know. And then let's say that we had a sale of this inventory. So February 2nd, we sold this inventory. Let's say we sold all 15 units. And let's say we got $6,000. And, $6,000, we charged for it, they bought it. $6,000 in revenue. But let's say that the consumer came to us and they said, hey, we're sort of in the same situation as you. We don't want to pay you until the end of the month. And let's say we go, oh, that sort of sucks, but okay, whatever. So we say, we'll accept that. We trust you too. We're not going to charge you any interest. We're not going to make any crazy deal. So you could just pay us at the end of the month. So now these people owe us. So we're going to call that receivable. Accounts receivable. Because, it's cash that we, it's an account that we're hoping to receive. And at the same time, as always, we used all of our inventory. Sold all 15 units, so minus 300 inventory, and then minus 300 costs of goods sold. Yeehaw. So again, as you can see here, all we've done is we've replaced cash with this accounts receivable, accounts payable. Again, you know, it's a liability to pay, and then it's an asset. We have money, you know, hopefully coming in, so we'll call it an asset. Accounts receivable. Then let's say that our customers on the 15th came to us and they said, hey, great news, really great news. We didn't have the cash problems we thought we had, and we really like you guys, so we're going to pay you right now. And we said, oh, that's great. So they pay us the $6,000, you know, on February 15th. They pay us the $6,000 they owe us. So we get $6,000 in cash. Well, what do? Minus $6,000 in accounts receivable. You know, and again, this is an asset swap, but it's a little bit different this time because, you know, we're receiving the cash that they owed us. You know, the accounts receivable goes down because our cash is going up. They're actually paid us on the 15th. And I want you to notice here, you know, again, we recognize the revenue when we earned it, when we actually made the sale, the revenue recognition. We matched the expenses, the things that, you know, went along with the revenue right away. And then when we finally receive the cash, you know, that's just, you know, an accounting procedure. Taking away the receivable, increasing our cash. There's no revenue, no expenses, none of that earned or recorded or whatever when we receive the cash in this situation. So just to point that out. Okay, and then I think that might be all that I wanted to do. You know what? Let's do something else. You know what? No. I'm not going to deal with that just yet. So then let's say the end of the month happened, and we're really happy, and, you know, that's good. So end of the month happening. Now it's time to do our adjusting entries again. 4. So our adjusting entry 4. So what has happened? Well, 1, you know, rent. It's the same. That's the beauty of when things are straight line and they're all the same. You can just copy and paste. So we have the rent again. Accumulated depreciation. Okay, we were doing that monthly and everything, so that should be the same. And then supplies. You know what? Let's say that we looked this time, you know, we had $100. Then we used 50, so we only had 50 left. We didn't buy any, and then we took an inventory, not an inventory, a supply count again, and let's say we only had $10 of supplies worth. So we only had $10 left over, and then, you know, we had 50. So that means we used $40 of supplies. Supplies expense. And then, I don't know if you remember this, but, you know, this will just give you a good sense of, hey, you always need to be organized. But, you know, all the way back here with, you know, prepaid marketing, we said, hey, you know, with the marketing people would next month do the marketing for us. Well, next month has come and gone, and they, you know, let's say you checked on them and they did the marketing for us. That's why we're able to charge more, you know, I mean, not really, I'm just giving an example here. So now that the rest of that $50 of prepaid marketing is gone, and now we can actually recognize the $50 marketing expense. And that's the adjusting. So, you know, I specifically said, oh, wait till next month, because I just want to get you, you know, help you get a feel for when it comes to these adjusting entries, you really need to keep track of what's gone on. Not just in this month, but, you know, is there anything in the previous month that can carry over? And this is, believe it or not, a simple example. So, in real life, or even just as you go farther in accounting courses, there's going to be all these different accounts with all these different stipulations, how long they last and what happens. And you need to have a method of keeping track of that. Just always, it could be you write it down on the side. Honestly, in industry practice, you're going to have a computer system that helps you do that. But, again, we're just going to keep things simple for right now. And those are the adjusting entries. So, again, a lot of what happened last month, because, it's monthly, it's the same thing. We kept track of our information. We know that. So that's good. So I'm going to start off, January, February, March. Crazy March. So we're going to start off March a little bit differently. I want to do one more thing, and we can repeat a lot of these steps, but just for time purposes, I just want to show you something. So on March 1st. And I just want to get you in the idea for what's going on here. On March 1st, what we did is, as the company, we issued a bond, okay? And a bond is a loan. We issued a bond, meaning that we're the one who received the money, and then we're going to have to eventually pay it back, and we pay back interest. So let's say that it was a $1,000 bond, 10% interest. And let's say this interest, let it 10% interest per month. Because most of the time, with 10% interest, No. 10% interest. Sorry. 10% interest. Okay? So how would we initially record that? Well, again, we're issuing the bond. So at first we receive $1,000 in cash. And then over here, we have $1,000. Oh, and sorry, I forgot to mention, with this payable account, we haven't paid it yet. Oh, you know what? I remember me saying, hey, we would. So sorry. I forgot about that. I just realized that. Don't worry, I'll give you all your money back. Okay. So we said we would pay this $300 in accounts payable. So, we do. So let's say we decrease cash by $300 because we're finally paying, and then we're going to decrease accounts payable. Voila. Okay. Sorry about that, guys. Again, sort of slipped my mind. But anyway, so March 1st, issued a $1,000 bond. $1,000, we get it in cash, and we have $1,000 in bonds payable. Because we're eventually going to have to pay the $1,000. That's how a bond works. When you issue a bond, you say something along the lines of, hey, give me the money right now, I'll pay it back later. In the meantime, I'll pay some form of interest. Now, bonds can get very complicated, and there's a ton of different types of bonds out there. I just sort of want to expose you to the idea of how something works right now. So that's all that I'm trying to do here. So trust me, there will be whole videos later on all the different types of bonds, how to account for bonds. I'm just giving you a simple example. $1,000, and we're going to say they're at par. Now, what does par mean? Par just means it's what the bond says it's worth compared to what you paid for it. So a $1,000 bond means that you're going to pay $1,000. If you're issuing the bond at the end, you're going to pay back $1,000. Par means that the cash you received. So it means you actually initially received $1,000 and then later you're paying $1,000. That's what par means. And sometimes that's not always the case. say that for some reason, you know, you have a bad credit score, people think you're untrustworthy, who knows what. So let's say you're going to pay them $1,000 at the end of the bond term, but they say, nah, I want you to, you know, the interest isn't enough for me. I want to only pay $900. So from the investor's standpoint, I pay $900, I get interest, and then I get $1,000 back at the end. You know, that would not be at par. That would be at a discount is what they call it. Now, again, there's a whole section for bonds and the different types of bonds and everything like that. I just want to give you like a brief little introduction. So, you know, let's say there's a $1,000 bond, which for the company we're issuing, so, and it's at par, which means we get $1,000 cash and we're eventually going to have to pay $1,000. You know, again, and everything else, you know, let's say things happen similar to what's been happening here. And then, you know, I just want to get you, you know, the idea. Let's say nothing happened this month for simplicity's sake, just so we can continue. Adjusting entry. Now, we have $1,000 in, you know, bonds payable. And again, we have interest. Well, guess what? That interest accrues. So, 1,000 times the 0.10 interest equals 100. $100 of interest is accrued. So adjusting, AGE1. Well, actually, we're on 9. 9 for the bond. You know, again, like I'm really just showing you everything in relation to the bond. There'd still be a lot of these other adjusting entries. But, you know, we have a $100 essentially accrued. Now, here's the deal. Actually, they didn't accrue because whenever an interest rate is stated, an interest rate is always stated annually. So that's 10% interest for the year. So this is $100 for this first year. $100 a year. So $100 divided by 12, 8.33. So we have 8.33 8.33 in interest payable, negative 8.33 interest expense. Now again, you know, I'm just trying to sort of show you the idea here, the idea of interest. You know, we get $1,000, we have to pay $1,000 later, and so, you know, that we're going to keep track of separately compared to the interest. You know, the interest accrues, and then we split it up and figure out what it is per month, because again, we've only been dealing with months. Interest is always stated annually, and bam, here we go. You know, increase. You know, this is the same side. You know, you might be going, oh, this is balanced. Yes, remember, this is, you know, equal. This is all one side. So, the same side is going up, but at the same time going down. So, everything balances. So, at the end of the day, assets are still equaling liabilities plus equity. We're good. And again, right now I'm sort of regretting showing you the bond example. I guess I got a little bit enthusiastic. But again, I just wanted to say, you know, here are some common things that happen in business and how you respond to them. And again, remember my disclaimers. Accounting for bonds can get really complicated. Accounting for inventory can get really complicated. You know, it's so, you know, as we continue through this these tutorials, I'll start bringing in and I'll start showing you, okay, let's make this example a little bit more real life. Here are some complicated, you know, sticky situations, interesting issues that can happen, and how we can continue to account for them, and how we make things a little bit more complicated. But again, today I just sort of wanted to show you the starting basic ideas, basic accounts, how we keep track of them, you know, how we record them. And again, I hope you see I've constantly been trying to go back and explain why and how. So again, a lot of this is going to be a lot of crazy moving parts. You know, I'm throwing a lot at you at any one given time. But again, you know, don't worry about it. We'll keep on going over this. Either next video or the video after that, I'm just going to have like a comprehensive example and go over some questions and stop and pause and make sure everyone's up to speed. But in the meantime, continue to look over this. If you have a study book, look over that. And I look forward to seeing you next time. Have a great day.